Good evening, ladies and gentlemen, and welcome to our class on trend trading. Tonight's class is powered by Investing.com, and we'd all like to thank you for being part of the Investing.com family. And our sponsor tonight is CMS Capital Markets Trader, one of the world's leading platform providers. And they are our sponsors for tonight. Now, CMS Trader is one of the best, most technologically advanced trading platforms in the marketplace. Now, because they are a regulated provider, I'm required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risk and take care to manage your exposure. Now, if you want, while we're talking about, okay, ladies and gentlemen, I'm just barely starting and I'm already getting odd and end messages from you. Okay, there is absolutely nothing I can do with the sound. If you're having a problem with the sound, it is most likely due to the internet in your country and also due to your computer. Check your computer volumes, check your speakers, check your hookup, and then if anything, sign out and sign back in. If the screens aren't moving the way you think or they're not moving for you, then again, it is on your side, and either hit your refresh button on your computer or log out and log back in. Okay, so I'm sorry about that, but there's not much else I can do. Because I have all kinds of monitors they give me. I can tell what's coming out of my side, but I can't. If you're having a problem on your side, it is on your side. So sorry about that. So let's get back to class. Now, if you want, you can go to www.cmstrader.com and very quickly just click on the sell or the buy button, and it'll open up 3 lines of information. Fill them out. It's mostly you're picking a password and a email address. And you'll have in seconds a demo platform open for you, and you can actually follow along and use the charts there from their platform and follow along in our class tonight on trend trading. Because CMS is a great way to trade. Like I said before, they're a regulated provider. They have very simple trading platform with the most advanced dynamic screens. They have big view screens. They also have fast execution, impeccable service. There's no dealer intervention. There's no conflict of interest between the broker and the trader, and they offer exceptional education. Now, when you trade with CMS Trader, you have various types of trading accounts. You can trade micro and standard lots. You get free trading signals. You have unlimited access to their platforms. You get daily market review, updates, and technical analysis, and you can have multilingual customer support managers. Okay. So they offer everything you need for successful trading. They have a wide range of instruments for Forex, CFDs for stocks, commodities, and indices. And you can trade just about anything you want from the global markets with CMS Trader. You can also use their watch, copy, and profit. This means you can watch what other traders are doing, join their social trading, and copy the more successful traders with just one click if you want to increase your profits or learn from what they're doing. Now, you can also learn to become an independent trader using their education. So when you're with CMS, just click on the education tab, and you'll see all of their ebooks, their one-on-one sessions, their video tutorials, all of their seminars, everything that you want for becoming a successful trader. So tonight we're going to be talking about trend trading. Now, trend following is perhaps the most popular and long-term strategy in all financial markets. As a trading strategy, it is exceedingly effective and profitable. It is pretty much straightforward in its methodology, and there are many individuals, past and present, famous and obscure, who have used these strategies for success and riches. Trend trading is one of the oldest strategies in the marketplace. Now, we should note that the technical aspects of trend following, in fact, are quite simple, but also that it requires, before everything else, discipline, sound money management, and patience from a trader. Trend following is not a short-term method, and patience and determination are as important as correct analysis to get a result. Trends are created by powerful underlying economic factors which may not be clear to those who are not familiar with fundamental analysis. But the simple pattern created by the price action in response to those economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader, like you and me, has as much potential of success as the experienced analyst if he can control his emotion and behave logically. To apply this strategy, we must first be aware of the existence of a trend. Without identifying a trend, we would be gambling, basically. And that's not the purpose of trading Forex. Both fundamental and technical analysis can be employed for identifying a trend. And both of them have their advantages and drawbacks. It is in general a good idea to use a combination of them for deciding for the trend's character and deciding on our entry and exit points. So in other words, fundamental analysis is the use of things like a speech by Mario Draghi from the ECB, maybe more political tension with North Korea, an election somewhere around the world, press headlines, something from craziness from Donald Trump. This might tell you that the markets are going to do something, not just volatile. If Mario Draghi says he's going to be cutting, increasing interest rates and cutting back his stimulus, that's very good for the euro. We're going to see the euro climb, correct? But that's a good assumption. It's a fairly good analysis, but you're not going to be able to predict how far the euro is going to climb. So if that euro starts in an uptrend, how far is it going to go? When is it going to ease down a little and then continue its uptrend? When is it going to peak? When is it going to culminate? That can only be decided using what's called technical analysis, or in other words, prices on charts. Now, when these prices are plotted on a chart, we have to be able to interpret those. And the first line, or the most important line we have, is our trend line. And general observation of a market swing points is the first point of call in determining if a market is trending. If you do not see a pattern of higher highs and higher lows, or lower highs and lower lows, but instead you see sideways price movement with no obvious general up or down direction to it, then you are probably looking at a range-bound market, or one that is simply chopping back and forth. And it's not going to give you an opportunity to trade the trends. So you shouldn't have to think too hard about whether a market is trending or not. Most traders make trend observations way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending. Now, trending simply means, is it moving up or down? So when we talk about higher highs and higher lows, that's the peaks and the valleys created by market movement. So in other words, in an uptrend, as prices moving up, we have higher highs and then higher lows. Higher highs, then in the last point, higher lows, higher highs, higher lows. And we see the market moving up. Now, we would like to see a beautiful uptrend pattern like this, but you could have a weak uptrend, or you can have a very choppy uptrend, but you're still having an uptrend. So because what you have to do is first determine if you're actually in a trending market. Downtrend is exactly the opposite. So once you've identified a market that is truly moving in an uptrend or a downtrend, Now, granted, we would all like to see beautiful, strong uptrends or downtrends because that makes our decisions in our life very easy. But they're not all going to be that beautiful. Then we have to start doing some analysis. So you must first choose whether you want to employ technical or fundamental analysis in your method or a combination of both. For both, most of us smarties, or most of us who are trading in the market, and most of us that aren't black boxes or computers, we trade from both. Because I'm not going to ignore the newspaper. I'm not going to ignore a speech. I'm not going to ignore a terrorist act, and I'm going to know about it. So I'm going to immediately know this fundamental analysis because I'm part of the world. I can't turn off the data that's flowing into my world. So we can combine it together to make a decision. But the first thing you have to do, because before you can just start trading, you have to figure out what your trading plan is and combine the rules or the things you're going to be using. Now, again, fundamental analysis can provide you with information which can predict the strength and the length of a trend, while technical analysis can show you how it develops. It is possible to base your strategy on one of these to the exclusion of the other, but it's still very possible to earn profit if you're lucky enough. But our principle has always been to reduce the role of luck to as little as possible. Fundamental analysis is more reliable than technical analysis in defining a trend that has long-term potential. But without technical analysis, it would be very difficult to decide when and how to trade. So in other words, what happened today in the markets? All over the papers. Apple's in panic. They're finding software problems right before the launch of their new Apple iPhone 8, I guess it is. And the markets are collapsing. Now, or the price of Apple is collapsing. Okay, that's fundamentals. Okay. Now, how do you know, or how would you determine if we've seen Apple move into a downtrend and how far it should be going down? So technical analysis can suggest the beginning of a trend, but it's unlikely to tell you much about the length and the strength of the same. Thus, I suggest that you use both technical and fundamental methods for your trend following strategy, with fundamental factors eliminating the false signals of technical analysis and the technical tools providing you with time price frame for deciding entry points. Now, how do I decide on an existence of a trend? There are many technical tools that can signal this phenomena, but there are also an equal amount of false signals generated by them. Remember that there are only three kinds of trends that exist at any time: flat, up, and down. And it's possible to speak of trends between any 2 points on a price chart. Simply take two random points on a chart and draw the moving average on it. And the pattern that arises can be analyzed as a trend. Thus, it is always necessary to have at least a basic understanding of the economic factors that create trends before deciding on a validity of a chart pattern. Now, there are about 1 million trend trading strategies out there. Tonight we're going to talk about a brief couple. But in your handouts, I put in a list, and hopefully you got it with the links, the hyperlinks, I think of 124 different strategies based on trends. But you have to understand, number one, how to recognize a trend, what indicators and oscillators you need to validate that trend, and then how to use them. The trend that we seek to trade is different from random fluctuations. Range patterns and similar price movements in that price itself, in the absence of any technical indicator, can still be recognized as showing a trend. In other words, there are some driving convictions behind price action which allows a trader to easily identify it visually. So in other words, when we see price moving in a pattern, here we see a downtrend. We see lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and this is how markets move, peaks and thrusts, peaks and thrusts. Because then we can drop on a moving average and combine that moving average with the peaks and thrusts to determine or make trading decisions. One of the most common ways to use trend trading strategies is with moving averages. Okay. So if the trend can be identified visually, why use technical tools? Even though we can notice the existence of a trend, we still need technical tools to trade it for time. Technical tools like stochastics, MACD, moving average, will give us the entry and exit points, okay? Because we have to determine where we're going to enter a market. And if you use things like stochastics divergence, it's going to, as the stochastics reach higher highs and higher lows also, so is price chart, and they will help you give you those entry points. Okay. Trending markets tend to make strong moves in the direction of a trend, followed by periods of consolidation or counter trend retraces before the next leg in the direction of a trend. You will notice this pattern happens in almost any trend you can find. Typically, what happens to many traders is that they will make some money during periods of strong directional trend movement, but then they continue to trade as the market takes a breather from that trend and consolidates. It's these periods when a trader gives up all of his gains they just made when the market was moving aggressively. And again, with that same peaks and thrusts in the downtrend, you could have entered all of these trades as it crossed the moving average lines and made those peaks and thrusts. Trade 1, trade 2, trade 3, trade 4. Each one of those worked in conjunction with the moving average and the peaks and thrusts of the trend. And you could have turned that into a lot of profit, okay, because you combine your moving average with your peaks and thrusts. And if you learn how to read these peaks and thrusts and the moving averages, on top of it, you can combine it with candlesticks, you would have been very accurate in these trades. You need to learn to identify the different parts of a trend. This will help you avoid overtrading during choppy and consolidation periods and will give you better chance at profiting when trends make a strong move. Here is an example, okay, of what I'm talking about. Price is moving up. Okay. It eased back down, moved up, eased down, moved up, eased down. Again, because when you have a good solid form trend, this is exactly what happens in the market. So here we can see an uptrending market which consists of strong upward moves, followed by periods of consolidated or shallow retraces lower before the uptrend resumes. Okay. We can see that a trending market tends to move in spurts, moving in the direction of the trend, then stalling to take a breath before another leg in that direction trend. Now all the trends are obviously not exactly the same, but we do typically see the general pattern described, a forceful move in a direction of a trend followed by a period of consolidation. So here we see two completely different assets, and these are real live assets, and you see the general same movement, the peaks and the thrusts, the peaks and the thrusts, and the same general movement. Okay, and combining that with a trend line, each time it touches that trend line, we see it bounce off of there. But the whole idea is not to get these little moves. Now you can make little moves entering every time down here and exiting here, entering here, exiting there, and make, or entering here and realizing that these are the peaks and the thrusts and trading all the way to here till the market reverses itself. But the whole idea is to be able to realize this reversal and get out of that market. No, because you entered the market here and you can get out here after it's broken the trend line. Okay, you would want to make sure you exited that market, because remember, a trend line acts as support or resistance. But these are very common trends. These are not trends made up in a textbook. These are trends of how the market moves in real price in real time. Now these retraces are when we have the highest potential for a high probability entry within the trend. Often a market will retrace to approximately the level of its previous swing point before the trend resumes. In other words, push up, create the lower low, the higher low, and then retrace and bounce back off of there. So we could have entered in each one of these trades. The market will typically retrace back to the previous swing point area and then bounce higher. Because basically what you're saying is if you have market conviction, especially if this is supported, the general price move is supported with other things like moving averages and MACD as well as volume. So you have a strong uptrend. So the buyers are in there buying up. At some given point, they need a break. They're going to take a breather. Okay. When you see that breather, okay, retrace, and then the buyers come back in the market, they're going to gather that momentum to push that trend forward again. Then they're going to have to retrace because they're going to ease off. Okay, because they're just bought up. They need a break. They need some time. Or they spent all the money they have buying already, and now they're sitting back because they have lots of buyers and more. But if you have volume supporting your trend, and you have a beautiful trend line, and you have the retraces and a nice trend line, guess what? You can start making trading decisions. Now, market timing is important. Market timing never works when one is trying to predict reversal points on a technical basis. However, market timing in the context of a trend with the purpose of picking the counter trend extremes and using them to enter a trade is necessary and profitable. And there lies the main principle of trend following strategy. Recognize the trend, identify the counter trend move, and use them to enter the trade in the direction of the trend. Okay, simple. Recognize the trend, identify counter trend moves, and use them to enter a trade in the direction of the trend. In other words, recognize the trend, recognize the peaks and the thrusts. Okay, when you finish the thrust, okay, it's going to ease. Recognize that and enter then in the direction of the trend. So how do I make my trade with technical analysis? The best tools to trade for trend following are supplied by moving averages and simple price charts. Bar charts, candlesticks, and many others can be equally useful if employed with moving averages. It is also possible to use moving average crossovers and a myriad of other methods. But whichever you choose, you should ensure that you do not complicate the main aspect of your strategy, which is trend following. Too many people, you should be using trends for everything. A trend line should be on your chart for everything. Okay. But there's a difference between a trend line and trends, because a trend line can be invalidated. Okay. A trend, you can have many trend lines within a trend. So the first thing we want is to find a trend. A trend is a market moving in a direction. Okay. So we don't want to overcomplicate it. We want to use the barest essential if you're using a trend following strategy. If you're using other strategies, that's a whole different story. But a trend following strategy is basically trading based on the trend. So we don't want to get too overcomplicated. Now, one of the best indicators to use is either moving averages or MACD, which is moving averages, convergence, and divergence. Okay. Because you need to use at least one other technical indicator to give you some type of validation. Okay. Because you never want to trade from any single method. So if you want to trade on a weekly or daily basis, the 100-day moving average will probably be the best to capture most of the important trends for you. Anything with a longer period is likely to be meaningless because of too much data discarded. And at any time frame that is too much below the 100-day period may be too sensitive to price action. But as usual, one can either use other time frames below 100, provided that he doesn't clutter his screen with lots of indicators, charts, and tools. So as you can see here, all we're looking at is we're looking at a simple moving average and our trend forecasting. And if you stay strict, because this is a fairly straightforward strategy. You want to look for price movements, peaks and thrust peaks. And granted, this doesn't happen all the time. Okay, you want to look for a well-developed trend. Once you've identified, you can very quickly look at your charts. And once you've identified an asset that's moving in one of these well-defined trends, you can then work with that to put the rest of your stuff and see if you can get some trades in there. It doesn't mean that all the markets are going to be sitting around doing all the same things, but when you find a market that is doing that, if you find a euro US dollar is in a very nice trend, okay, you're going to probably find that so is the pound dollar and so is the Australian dollar, because it probably means that the dollar has gotten some momentum, or the dollar is easing down, or the Japanese yen has happened to do something. So you'll find that very common. Okay. Now this trading method involves a risk management component that uses 3 elements: number of shares held, or number of how many you're trading, what contracts you're trading, the current market price, the current market volatility. An initial risk rule determines position size at any time of entry. Exactly how much you buy or sell is based on the size of your trading account and the volatility at issue. Changes in price may lead to a gradual reduction or an increase of initial trade. And on the other hand, adverse price movements may lead to an exit of the entire trade. Now, there are 3 important factors we want to look at. 1, price. One of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go next or what it should be as a general rule. These should be disregarded. A trader needs only to be worried about what the market is doing, not what the market might do. The current price and only the price tells you what the price is and the market is doing. Money management. Another decisive factor of trend following is not timing of the trades or an indicator, but rather the decision on how much to trade over the course of the trend. Risk control. Cut loss is the rule. This means that during periods of higher market volatility, the trading size is reduced. During losing periods, positions are reduced and trade sizes are cut back. The main objective here is to preserve capital until more positive trends appear. So, rules. Trend following should be systematic. Price and time are always pivotal at all times. This technique is not based on the analysis of fundamental supply and demand factors. So let's get a little bit more detail. In Forex, bullish and bearish trends are typically equal as violent and potent. Whereas in equity markets, we tend to see slower move price action in a bull market along with lower volatility. Downtrending markets tend to be fast and volatile in equity markets. Forex trends tend to be the same in their volatility as price moves up or down. The main reason, because this is one currency against another as any given pair, and this results in more balanced price movement. So, position size. How do you decide how much you're going to enter the markets? Well, a lot of it's depending on your account size. The other is using indicators like ATR to measure the size and the strength of the market to determine how much you want to enter the market. Now, there's an old adage that goes, the trend is your friend until it ends. Okay. So this one line pretty much sums it up. This one line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the trader is often advised to look to mitigate the loss so the reversal doesn't damage their trading account too badly. In an effort to be as precise as possible, many traders will move down to a lower time frame in an effort to get more detailed look at a move inside a larger term. So what we're looking for is a trend that exhibits higher highs and lower lows. Okay. Traders can also look to use indicators. There are numerous indicator options for this premise. Many traders will look to oscillators such as RSI and MACD to trigger their position. Other popular options are MACD, stochastic, CCI, and moving average crossovers. Traders look to speculate with trends with only to focus on the signal that moves in that direction. Okay. Exit points. Exit on three average true range moves against the position from the peak reading. In other words, when you get the fall below the moving average, that's an exit signal for you. Thereby, we have a theoretical loss of 60 basis points. No intraday stops are used, so a close beyond the 3 ATR units, if you're using average true response, are needed to trigger the following. Okay. Remember, the trading universe is huge, and no matter what you look at, you can never predict what's coming next. The investment universe you can choose from have much greater impact than tweaking buy and sell rules. So choose wisely. You should choose a broad set of markets. Okay. But remember, trends develop for a reason. Now, after all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movement. But the fact of the matter is that biases do exist. Trends do take place, and in many cases, those trends may continue. These types of strategies are endless, and as you can see from the handout, there's a lot of them. So please refer to the handout for class. But let's look at a simple Forex trading strategy for trends. The simplest trend following strategy uses moving averages. The variation which can be exhibited are many. They can be used 1 or 2 or 3 different moving averages, which may be simple rate averages or exponential weighted moving averages. Trading rules can be complex with very different weights applied to portfolio components, or they can be very simple. Such strategies seldom survive the test of an actual trading. If a currency pair cannot be traded successfully with a simple trade following strategy, it is unlikely to be realistically to improve by adding lots more levels of complexity to that same technique. Accordingly, the strategies investigated were simplest of all, with a single moving average. This was the average rate of the number of days. If the actual rate on a day was above the moving average, then the strategy gave a long signal. In other words, the buy. If it was below, then the signal was to go short. The actual number of days in the average was chosen to be that which gave the best information ratio for the currency. So we're going to take a look at this, and if you just simply use the long and short strategy, okay, using the moving average above and below the current price line, okay, we will see the results. The currencies which tested were based on the MSCI index without some or more minor elements. As can be seen, a number of currencies exhibit satisfactory trend following behavior, but others definitely do not. Those which do are shown with the information ratio in bold. Okay. So let's take a look at this. If you simply traded these currencies when they were moving in trends, you could calculate what and this is what our tabulation came out. A 69 moving day average for the USD JPY was the most effective, and it gave you an annual rate of return of 9.949%. The average number of trades per year was 9.9 or 10 trades, and it gave you an information ratio of 88. But that meant you would see an annual rate of every time the Japanese yen moved above or below the moving 69-day moving average and traded those, you would have made a 9.9 annual rate of return. We can see the USD CAD was a little bit wacko there. Okay, but these were tested and tried. Thus, it is relatively easy to select those currencies which are sufficiently trend following to include in your portfolio. Figure 1 shows the cumulative returns for those strategies which were selected. Trading costs were included at a level of 3 basis points for all currency, which means is your spread. An interesting point arises when costs are included. Strategies with 2 moving averages are popular, and when optimized without costs, almost inevitably provide better back-tested returns, because that means that you're making small amounts of profit. However, when costs are included, then strategies which trade less frequently do proportionally better. This means in practice that optimizing for the 2 best moving averages frequently results in them both having the same number of days. In other words, they are the same, and the 2 moving averages have collapsed into 1. Thus, the decision to only use 1 moving average on the grounds of the simplicity is further implied. So again, here we can see the same chart with the same results. But then you have to factor in market volatility. It is often possible to improve the returns of a trend following strategy by adjusting the face value of the trades according to the volatility of the underlying market. In general, by reducing the face value at times of very high volatility, the information ratio is improved, and thereby is less whipsaw effect but for large rapid moves. However, varying that face amount of trades according to the complex rules means that trading strategy is very vulnerable to over-optimization. In other words, if we simply take a volatility adjustment by saying on days that the market is very volatile, we will reduce it from the market, and days that actually we just don't trade it, and then we can use a rate of 85%. And okay. And in other words, when the information ratio is above 85%, we just don't trade that asset at that time, because we don't want to trade in very volatile markets. When it falls below, we go back to trading again. Okay. According to ensure that there were not too many variables which could be optimized to produce a good back-tested result, we varied a single optimization parameter, which was the level of distribution of historical volatility of each currency. To the best level was found to be 85. Thus, whenever the historical volatility of the FX rate, calculated as a standard deviation of a previous 21 days, was above 85% of its range on the face amount of the information, it was reduced to 0. We just wouldn't trade it. When the volatility moved back below the 85%, it would go back to its original trend level. And we could see at all of these currencies, okay, by simply trading the simple moving average trading strategy using a single moving average, we would have realized profit on every one of these, or returns on every one of those assets over a period of time. And we tested back over several years. We can see going all the way back to 1998 that we would have been successful. Okay. So if we look at the last 17 years of currency repairs, we would have seen an annual rate of return of 5.57%. The worst month we would have been a loss of 2.2. The best month, 5.18. Okay. But you can see it's successfully traded, but you have to trade it on a steady basis because you have to own it, keep it simple, and get it done. Now, there's nothing in this class that I can teach you fast enough to understand all this. All I'm trying to do is give you some food for thought. Okay. There are, like I said, a billion strategies, but the simplest one is a simple moving average, okay, on a currency, okay, whether it's a 100 time period, 100 day, or you can use a crossover with a 20-day, 50-day, or 20, 50, and 100, and combine that with the trends on a chart using a bar chart or candlestick chart, and when it breaks above the moving average, trade it to go up. When it falls below, trade it to go down. Confirm it with a MACD crossover. Watch your volume. And you've got a pretty simple trading strategy. Not overcomplicated. Remember, use your risk management at all times. Keep your positions relatively stable. Keep your emotions out of the market. And you can simply build yourself a very nice trading plan. So thank you very much for joining us tonight. And this class was recorded. You can access it by using the same link you came to tonight's class. The handout is there. I can't help you if you can't download it. It's your computer system. Okay. And thank you very much for joining us. And again, I can't help you with this stuff. So have a very, very good night now, and we'll talk to you again real soon. Bye now.